Afternoon, everyone. If I could call you to attention. My name's John Glenn. I'm the Economic Secretary to the Treasury. I'm the Chancellor's Deputy for Financial Services, and I'm also responsible for the Green Finance Agenda, which I've been working on since I took up this post in January 2018. So thank you very much for joining us today in the UK Pavilion, which I think we can all agree has been a very significant milestone in terms of the role of finance in dealing with the climate challenge. And welcome to all of those online. The focus of this event is on how governments, regulators and international bodies are working together to redesign the architecture of the financial system and embed climate change as a key concern. Now, this being the UK Pavilion, we will first hear from the heads of the UK's main financial regulators about how their organisations are tackling the challenge at hand. But before I invite Andrew and Nikhil to give some remarks, I think I'd also like to thank them for the work that we do together in order to get to this milestone today. Greening finance so far has been taking place at the national level, and probably it'd be fair to say in coalitions of the willing. But now it's time to export those learnings onto the international stage so that we can establish a global baseline and secure the broadest based action possible. So you'll hear this afternoon from some of the main players on that international stage in the second part of the event, and they're ready waiting for us. But I'd like to say a little bit, if I may, about the UK government's latest green finance policy announcement. A key ambition of Finance Day is that each and every financial decision takes climate change into account. So we've taken that idea to heart in the UK and just got on with it. And that's why the Chancellor announced this morning that the UK will be the first net zero aligned financial centre. And that means setting clear expectations that firms will publish net zero transition plans. But we understand that transition planning is still in its infancy, and that's why we'll establish over the next 12 months a high-level UK transition planning task force, bringing the best of industry and academia together with the regulators and the third sector. And it's our intention that this task force will set the gold standard for what a good quality transition plan looks like. We'll pioneer those standards in the UK, and of course we'd be delighted to share them and our lessons learned internationally. But this, I can really promise you, won't be a tick box exercise. As the industry upskills, we'll look to strengthen regulatory requirements over time. But if we are to make good on the promise of COP26, we must make sure that firms' individual actions collectively drive the desired real-world impact. And that's why next year's update to our green finance strategy will look ahead out to 2050, setting out a transition pathway for the sector as a whole. And that will include policies to ensure that private financial flows actually shift to financing a net zero world. Enough from me. Back to the event today. I'd like to start off by turning to our first speaker, Andrew Bailey, Governor of the Bank of England. Andrew was keenly involved in the bank's very earliest work on climate-related financial risk and continues to champion the bank's climate agenda today, and he will speak to us for around 10 minutes. Andrew Bailey.
Well, thank you, John. It's an absolute pleasure to be here. Pleasure to be here with lots of close colleagues, but also with Klaus and Andy and Eric. Sarah's a colleague, actually, I should say. But we probably spend, a good part of our lives on WebEx talking to one another, and climate change is an important part of that. So it does demonstrate, as I think does today, I must say, walking around here today, the energy and commitment that there is to put all our tools and powers to work to do our part to tackle climate change. I was asked earlier in an interview, by somebody who clearly wanted me to say something sceptical about all this, and I said, well, you just have to walk around here and see the energy and the commitment, that I think you do get the sense of the importance of the issue and how much we're committed to tackling it. So as John said, let me spend a bit of time. I want to talk a bit of time talking about what the Bank of England's doing. And as John said, we started out on this path back in 2015, so 6 years or so ago, when our work on climate was wholly focused on the risks to banks and insurers that we regulate. And that made sense because, particularly for insurance, which is where we started, obviously because for many insurers the life of the asset holdings are so long that the horizon of climate change was immediately relevant. You couldn't sort of duck the horizon issue. So 6 years later at the Bank of England, literally climate touches the whole of our organisation. Actually, Sarah makes sure it does as well, I should say. But it goes right from the way we run the Bank of England, how we run the building, to our holdings of corporate bonds for monetary policy purposes as an investor. And of course, still very much, as I'll come on to our role as a regulator. So it really is at the centre of what we do. And that's important. It's one of our key priorities. So let me try and piece together those different parts of our work and drawing on a few what I call sort of key pivot points to really also illustrate the ambitions we have for the future and where we will go. So as I said, just to sort of start at the start, as it were, the first pivot point is our role as a regulator, a microprudential regulator and a macroprudential regulator. We started that work in 2015. We've come a long way since then. The PRA, the prudential regulator, set its first climate-related supervisory expectations in 2019, which Sarah was a key part of. And that really has led, going back to this point about energy and commitment that I'll make, to a very clear step change amongst senior executives and boards of the firms that we regulate. We do see a genuine ambition to embed climate-related financial risks, demonstrating what can be achieved and where more can and should be done. And we've been helping with that. We set up our Climate Financial Risk Forum, which is a group of industry representatives chaired jointly with Nicole and colleagues at the FCA, which has just published its second set of practical guides with a particular emphasis on aiding smaller firms, which obviously don't have so much access to expertise. And we've shared all those learnings internationally. We've been particularly active as the UK, John and Chancellor and I and others during the UK's presidency of the G7 this year, focused particularly on disclosure. We've been particularly active and encouraging work in the Basel Committee on supervisory expectations and the Network for Greening the Financial System, of which Sarah's an important part of, and Frank Elderson has been here today as well from the ECB. But there's a lot further to go. So as we come to the next year, we'll be shifting gears in our supervisory approach domestically to ensure firms are identifying and addressing climate-related financial risks. And rather than focusing solely on enabling, we'll, through active supervision, be focusing also on ensuring that our supervisory expectations on climate change are met. And if and where progress is insufficient and assurance or remediation is needed, we will request clear plans, and where appropriate, we will consider exercise of powers and use of our wider toolkit as a supervisor. Now, a key part of this toolkit is regulatory capital requirements, or always has been really, and it will be used to ensure that firms have sufficient resources to absorb future financial losses. That was the origin of the work that started in 2015, because that supports the safety and soundness of firms, which is our key objective, and contributes to the stability of the financial system as a whole, which is our other key as a macroprudential regulator, is our key objective. Now, we already expect firms to hold capital against material climate-related financial risks, and our existing toolkit enables us to take action. But we do recognise that capital can and should have a bigger role to play. So last week we published a report that sets out our thinking on capital and what further work is needed to determine if there are more changes to the regulatory capital framework that need to be made. But there's one point that I want to be very clear on. What we can do with regulatory capital is to provide resilience against the consequences of climate change, the financial risks that come from it. But it's not a tool that can be used to address the causes of climate change. addressing those causes and driving transition is for climate policy. It's rightly the responsibility of governments. We can do our part, but we can't substitute for that. Now, the second pivot point is scenario analysis, and we spent several years developing climate scenarios as part of the work of the NGFS. It's a key tool to understanding how firms and economies are exposed to the risks from climate change under a range of potential future pathways. The Bank of England, alongside about more than 20 other NGFS members, is using these scenarios to run exercises. And as the results come in for us over the course of the next 12 months, we'll be able to assess the risks to the financial system. And these scenarios are not just for use by regulators and governments. The NGFS has deliberately made them openly available for use by firms, whether in finance or in the real economy, and for organisations to use in their scenario analysis. The NGFS, I think, rightly has been very open about how the scenarios have been constructed so they can be challenged. And I can tell you, having done one of those sessions at the Bank of England, doing any scenarios over the length of time that these scenarios need to run over is, to use the word, quite often heroic, but it's necessarily so. So we are now starting to use these scenarios for a range of other topics. Most obviously, the impact on the macroeconomy, both from the physical impacts of climate change and the different transition pathways and how they impact the economy. Our Monetary Policy Committee recently had its first discussion on climate change, and I'll come out to make an important point on this right at the end. So as the president of the G7 this year, we've used that role to catalyse action to prioritise further our understanding of the macroeconomic impacts of climate under different transition pathways. It's been interesting to my mind that has been a relatively later part of the whole framework to develop. So we will continue that work because it's important, and it frankly does need to do some catching up, I think, working together internationally, through the NGFS, through the finance tracks of the G7 and the G20. That brings me to my third of the three pivot points. For the past 2 years, we've issued broad TCFD-based climate disclosures. These disclosures set out our climate change strategy and demonstrate how companies can and should share information about the measurement of management of risks related to climate. Over the coming days at the Bank of England, we're going to launch a new approach to investment by the corporate bond purchase scheme that we run, drawing on feedback on a discussion paper we published earlier this year. And we're using here our role as an investor for monetary policy purposes to incentivise firms to take meaningful actions in support of climate transition. And that, I think, will be an important step forwards as we consider how the financial system, in a sense, understands and adapts and therefore influences the transition. We're also implementing changes to achieve our 2030 milestone towards meeting at the Bank of England, net zero emissions target for 2050 across all our operations. So let me finish. This brings me neatly, I think, to international cooperation, as John said. For many issues, we say global issues need global solutions, and if it's ever true of an issue, it's true of climate change. None of us can tackle it on our own. So we must, of course, go on working together after this conference is over, and I know we will. The NGFS has a very ambitious work programme. The Financial Stability Board, which Klaus is taking over the chair of, has an ambitious role to, in a sense, oversee everything that's going on in the sort of the regulatory and official world in that dimension. And I'll look forward to the panel conversation in a few minutes. So in 6 years of work, we've learnt a lot, but there's still a lot to do. And I want to conclude by highlighting 3 points here. First, in terms of its economic effects, I think we are already beginning to see the impact of climate change, which is why these macroeconomic scenarios are so important. I think if we look at what is going on in energy markets and energy prices at the moment, it's not the only story, but there is an element of the climate change story at work there, I'm very sure of, frankly. So it underlines why we need this work on macroeconomics. Second, closely related actually, we must ensure that the supply chains which will support the renewable economies of the future are robust. Otherwise, we'll compromise the change we must achieve. We also need, as we were discussing at one of the sessions this morning, to use economic scenarios to very transparently explain the economic impact of climate change, the impact of not tackling it, the impact of tackling it, the impact of being late tackling it. Third, we must use the power of disclosure for companies to incentivize change over an acceptable time frame. Now, I know that this message is not always popular. It doesn't have the message of stopping investment, but it does have a very strong message of incentivizing change. And that, to me, is the most realistic and important thing that we must achieve. Thank you.
Well, thank you very much, Andrew, for those thought-provoking remarks. I'd now like to invite Nikhil to address us. Nikhil's been in this role for the last 12 months and has put ESG right at the top of his agenda, and we look forward to hearing what he has to say now.
Thank you, John. It's great to be here with you, with Andrew, with some of our international partners as well. I was at COP in Morocco a few years ago in a different role, and it's really heartening to see finance right at the heart of this version of the summit. And that's because I think there is a really strong recognition now that businesses, governments, regulators, financial services firms, we all have a part to play in tackling the climate crisis. And the surveys we've done demonstrate that view is shared across society too. So in our last financial live survey, where we survey consumers in the UK, 4 out of 5 respondents believe that businesses have a wider responsibility to climate and the social agenda, as well as obviously their fiduciary duties to shareholders. And we're seeing that already translated into investment behaviour, with responsible investment funds accounting for almost 40% of net UK retail fund sales last year. So a really quite dramatic increase. And it's great to see such a strong international consensus here today that finance is a critical part of the solution. The Glasgow Financial Alliance for Net Zero, as financial regulators, we love new acronyms, so GFANZ, recognises that financial institutions can use their capital, their voice, their influence to encourage positive change. And we saw net zero commitments from more than 450 institutions, accounting for $130 trillion in assets. At the same time, though, recently we've seen growing skepticism about some companies and financial firms' green claims. And for us as a conduct regulator, we can't let this distrust and greenwashing persist and risk the flow of much-needed capital to help secure our futures. And that's why, as John said, environmental, social and governance issues are at the heart of our regulatory agenda and my agenda as CEO of the FCA. And I inherited from Andrew a huge amount of work that had already taken place at the FCA. In 2019, the FCA concluded a wide-ranging discussion process to set our direction on green finance. And 2 years on, we've delivered on those initial priorities. We've improved climate-related disclosures to support effective investor stewardship and drive innovation. We've written to the chairs of fund managers, putting them on notice that firms need to do a better job to justify and evidence their products' ESG credentials. And our supervisors, with additional training, will be following up much more directly with firms, and we'll be looking much more closely as firms submit their authorizations at the ESG agenda as well. But we know there's more to do, so today we've released our new strategy for positive change. In that, the themes of building trust in the market for ESG products and ensuring transparency along the value chain are at the heart of our future plans. And to tackle the challenges ahead, we'll continue our close collaboration with both public and private sector, because we know we need to keep learning from each other. Andrew already flagged the Climate Financial Risk Forum, which we work with the Bank of England and private sector partners on, and that's been doing important work. There are also 2 further themes that I'll mention this afternoon. First, consistent with the goal of Finance Day, our strategy announces a programme of work to support a market-led transition to a more sustainable economy. And as the FCA adapts to the Chancellor's expectation that we have regard to the government's commitment to a net zero economy in our regulation, we are working to embed climate and wider ESG considerations as a golden thread through everything that the FCA does, just as the Bank of England is doing in its own activities. We have a new ESG division led by an ESG director that's expanding and has a mandate right across the activities of the FCA and into our governance. And I'm really looking forward to the end of this conference because 3 of our staff seconded to Mark Carney's private financer will come back to help us do this work. As the global market for green debt grows, issuance was $375 billion in the year to the end of September. The UK is playing a central role. John didn't mention it, so I can advertise it for him. The UK government raised £16 billion recently in its first 2 green gilt transactions, and with the launch of the Infrastructure Bank in the UK in June, there's initial funding of £22 billion to support green infrastructure spending in the UK. We've seen private sector work with the London Stock Exchange Green Mark, now having 100 issuers meeting the criteria with over 140 billion of market capitalisation recognised in that way. And we are committed to seeing climate change and sustainability integrated into all financial transactions, not just dedicated sustainability labelled securities and investments. We're also naturally committed to internationally consistent outcomes, given we're at the heart of global markets, and so encouraged to see the launch this morning of the IFRS Foundation's International Sustainability Standards Board. Andrew and I were talking about that earlier, another acronym, the ISSB, a game changer and I think a crucial development in creating trust through transparency. The ISSB will set for the first time a global baseline of complete, consistent and comparable sustainability reporting standards. We at the FCA have been closely involved in this initiative as co-chair with Eric of the IOSCO's work stream on corporate sustainability disclosures, and really impressed with the prototype climate standard published today. I think the ISSB will build on the excellent work of the TCFD, which now has some 2,600 public supporters. We were really pleased to be supporting and be at the vanguard of supporting the TCFD's recommendation on disclosure rules, introducing those rules for our most prominent listed companies from January at the start of this year. And we have consulted on extending those further and received really broad support. So I can confirm today that by the end of this year, we will finalise new TCFD-aligned rules for a much wider scope of listed companies, as well as asset managers and FCA-regulated asset owners. In its roadmap to sustainable investing published last month, the government clarified new whole-of-economy sustainability disclosure requirements and confirmed that ISSB standards will form the backbone of corporate reporting elements in the UK. And we certainly hope that other jurisdictions will take a similar approach. And it was encouraging to see 36 jurisdictions support the ISSB release today. The FCA will have a central role in delivering the government's roadmap for listed companies, asset managers, asset owners, and investment products. And characteristically, the Chancellor's set a deadline of 2023, so we've got our work cut out in the next 18 months or so. And today we have launched a discussion paper on sustainable disclosure requirements and investment labels. Interesting, this is one area where industry wants us to regulate, and the industry wants us to step in and develop the policy. So we'll be looking to do that ahead of consulting on new proposals next spring. But to give you a taster, we anticipate 2 layers of disclosure, a concise and accessible consumer-facing layer, and more detailed underlying disclosures aimed primarily at institutional investors, with accompanying product labels that will then help retail investors navigate the increasingly complex ESG investment landscape. We're not going to waste time reinventing the wheel. We have an advisory group helping us with this work, and we're also going to have really close regard to IOSCO's recommendations on asset manager disclosures and the EU Sustainable Finance Disclosure Regulation. We want to encourage positive market-led solutions and build sound regulatory foundations with the appropriate guardrails. An immediate focus, as we heard this morning, is how best to support a market-led transition to a more sustainable economy, and very supportive of the ambition to make the UK the world's first net zero financial sector. We will engage with the Transition Plan Task Force announced this morning, building on the TCFD's recent guidance. We will also continue to examine how well our regulatory regime, supports the important role of active investor stewardship in driving positive change. I've talked a lot about the FCA's transformation in my first year and our desire to become even more a data regulator, more data-led. Last month, we ran a highly successful tech sprint to crowdsource creative ideas for effective regulation of ESG. And participants offered a range of solutions, from verification of companies' carbon offsetting programs to how impact scores can inform sustainable investment labels. And tomorrow, jointly with the City of London Corporation, we will announce 12 successful applicants to our digital sandbox pilot on ESG data and disclosure, which goes live early next year and which we hope will help participants develop proofs of concept and road test their ideas. So, as you can see, we have a busy and ambitious agenda. On some estimates, we need collective public-private investment of up to $150 trillion globally through to 2050 to keep us honest around the 1.5 degree target. So to help mobilize this capital, it's imperative that in the coming years we build a trusted market with international consistent frameworks and standards to support the seamless integration of climate and sustainability into business, risk and capital allocation decisions, to make sure that companies and financial services firms deliver credibly on transition plans, and to ensure that investors have access to products and services that genuinely meet their sustainability preferences. So we're ready with our partners, international and domestic, to walk the walk and take the next step on this journey to transform our sector and with it our economy and our collective future. Thank you very much.
Well, thank you very much, Nikhil. We've got 33 minutes left, and I hope that during this time we can hear from our panelists. I think what both our speakers have done is it really set out though that the climate change is a global problem, the inherent balance in terms of policy making at a national and international level is something that we need to focus on and resolve. So I will introduce the panelists now, and then I've got 4 questions that I would like to put to them, if I may. So on my immediate right is Erik Tejdean, who's Director General of Finansinspektionen, the Swedish Supervisory Authority, and Chair of the Sustainability Task Force at the International Organization of Securities Commissions, IOSCO. And then to his right is Sarah Breeden, the Executive Director for Financial Stability at the Bank of England and Chair of a work stream that Andrew just mentioned of the network of greening the financial system, and has also done a lot of work on scenarios as well. So I want to ask you about that in a moment. To her right is Andy Bauckhall, the Acting Undersecretary for International Affairs at the US Treasury, who I had the privilege to meet in Washington a few weeks ago, and Deputy Co-Chair of the G20 Sustainable Finance Working Group. And last but not least, Klaas Knott, the Vice Chair of the Financial Stability Board. So if I could start, I think one of the key themes that we all get in this space is the need for high quality, reliable and comparable data about businesses to understand the full range of environmental risks that they face and create. Perhaps I could start by asking Erik and Andy, what do you think that policymakers and regulators can do to help build, if you like, a strong global ecosystem for climate data and disclosure? Erik, would you like to start?
Thank you very much for inviting me, and thank you, Andy and Nikhil, for inspiring speeches. No, I think, of course, data is extremely important, and what we announced today, not we, but IFRS is, in cooperation with IOSCO, I think is an extremely important building block. So having a global baseline for disclosure, if you combine that with the recommendation on the asset management that we also came out with the other day, another work stream in the sustainable work group that I lead, and also on the ratings, because rating institutions, I think, to be honest, there are strong business interests to keep data opaque, to keep data for yourself, but to have it more standardized, more harmonized, I think that will drive this in the right direction. interestingly enough, when we started this working group, we asked stakeholders around the globe about how they, what they thought about the disclosure standards and the so-called alphabetic soup, the different kinds of privately or semi-privately led standards. Many of them sophisticated and good in itself, but again, a soup and many different standards. And to draw a little bit on the speeches early on, the strong message that came back was, please regulate. They wanted us to regulate because they wanted to have more harmonized. I had a discussion with some really important asset managers the other week, and they say, we really want to have a harmonized standard. Why do I talk about this? Because it's extremely also important to your questions on the data. So what we came out with, or IFRS announced today with the support of IOSCO, is to have a global baseline that hopefully will be incorporated in the different jurisdictions. This is not a given. So here IOSCO comes in. So if IOSCO, after scrutinizing this prototype for climate, endorse the standard, that is a pathway for a global acceptance. And I welcome the position by the UK authorities to already now say that this will be a part of your disclosure standard. Hopefully that is true also for other major jurisdictions, EU, US, and Asia, and hopefully also developing countries. We're not there yet, but the most ambitious plans are saying that we could be there already Q3, Q4 in the next year.
Yeah.
So I think that's important, optimistic, and to some extent answers your question on data, because if we have that kind of ecosystem harmonized, the data will also be harmonized.
Great. Thank you. Andy.
Thank you. I think there's clear demand from market participants for better information in this area, so they can make decisions more effectively going forward, and deal with climate-related financial risks from a standpoint of strength in knowing what is out there and what they need to do. A key part of this is having consistent data across jurisdictions, across sectors, so that companies are fully aware and not afraid to act on that data. In the G20 Sustainable Finance Working Group, we had which was recreated this year. U.S. Treasury is a co-chair along with the People's Bank of China. We worked on a roadmap that has a number of elements to it, including dealing with financial issues, dealing with Paris alignment, but also dealing with data and disclosures. The goal here is to advance the work in some of these other areas at IOSCO, at the FSB, in the IFRS. So discussions on all of these issues has been a key part of the SFWG this year, and has been built into the roadmap that was approved and endorsed by ministers just a couple weeks ago. Part of this is promoting a baseline reporting disclosure system through the ISSB, as has been discussed, and we look forward to the development of the ISSB standard, and U.S. Treasury was one of the groups that welcomed the announcements on this today. I think Nikhil described this as a game changer in terms of what the ISSB will do, and I think that is a good description of how we view it as well. The Sustainable Finance Working Group also has identified some implementation challenges, including for small and medium enterprises, as well as with emerging markets. And this will be part of the discussions that we'll be having in the Sustainable Finance Working Group next year. And we look forward to making progress on all of these issues. Let me stop there.
Thank you very much, Andy. So the second issue that I think it would be worth asking Sarah about is her advocacy for the climate scenario analysis. And that's both in domestic supervision and in international fora. So, Sarah, could you tell us a little bit more about what role you think this could play and where we need to go further in order to anticipate the challenges and inform policymaking?
Great, thank you very much. It's a real pleasure to be here. I think scenario analysis is absolutely foundational in supporting risk management and price discovery, and so making sure that the financial system is rising to the climate finance challenge. It's how we get the trillions pointed in the right direction. We all know that the changes to our climate are unprecedented, and so we need to look forwards, not backwards, if we're going to make the right decisions. And we also know that our future risks and our future opportunities are going to be determined by the actions we take now. So again, we need to look forwards, not backwards, if we're to make the right decisions. And scenario analysis enables us to do exactly that. We can use the climate data and disclosures that Eric and Andy talked about, and we can look forward to see the impact of different future climate pathways. And crucially, through considering what risks and opportunities might arise in the future, we can learn what action might be required today. Now, none of us knows exactly what future climate pathway we'll be on, but by looking across a range of scenarios, we can identify vulnerabilities, whether to the physical risks or to the transition risks, and we can work out the strategies that are needed to build resilience to them. For financial firms, that means they move from the static to the strategic. They can differentiate the leaders from the laggards, those that have got a great plan to get to net zero from those that don't have one. And for us central banks and supervisors, we can understand what risks might be building in our financial system and consider what actions we need to take now to reduce them. Stress testing for climate risks, as we talked about earlier this morning. So to my mind, scenario analysis really is an essential part of mainstreaming climate risk management and ensuring that the financial system that's now in the foreground on helping us manage the climate crisis is doing the right thing. Now, unfortunately, constructing these scenarios is fiendishly complicated. Modelling what's happening to the climate, to the transition, the financial system, and our economies are incredibly complex pursuits individually. Bringing them together in a coherent scenario is even harder. However, it is what is needed if our scenarios are to be decision useful and reflective of the world we'll face. So, given the complexity, challenges and costs of creating these scenarios are beyond most individual firms or institutions, the NGFS has developed a common set of global scenarios for everyone to use. We've combined the intellectual heft of central bank and other economists and the best climate scientists in the world to set out decision-useful scenarios that reflect the totality of the risks we face, physical, transitional, economic and financial. We've made them freely available for use by policymakers, financial firms, corporates, and they're already being used by more than 20 central banks and supervisors. I like to think of them as a global public good available for everyone to use as they work out how they're going to respond to climate change. There's much more to do, as you said, Minister. Financial firms need to continue to develop the skills and the methodologies to run climate scenarios as part of their business as usual risk management. We need academia, think tanks, consultancies to fill in the blanks between the high-level scenarios and make them into detailed ground-level decision-useful materials. In the NGFS, we're working on sectoral paths, for example, and more research is needed. Key questions to explore include What are the implications of different government policies on the transition on jobs, productivity, prices? What will be the impact of physical risks on assets and the economy? One final point, a key challenge is to work out not just what we need to do by 2050, the focus of much of our scenario analysis to date, given the importance of getting strategic alignment, but what do we need to do in the next 5 to 10 years? I think that's going to be a critical part of our future work from here.
Thank you very much, Sarah. I think what you've done there is teed up the next question, which is around transition planning. So if your scenario analysis, which I think it has helped move over the last 5 years from a situation where that link between climate change and finance was viewed somewhat skeptically to one now where there's widespread acceptance. The question now exists, and I'll put it to Klaas first and then back to you, Sarah, give you a break. What more can regulators and policymakers do to support that credible and effective transition planning that obviously today we've moved forward on in the UK as a government?
Well, thank you very much, and also thanks for having me here at this important event. I think the starting point of what I'm about to say would be that managing an orderly transition on the one hand, and preserving financial stability and making sure that financial institutions manage climate-related financial risks well are two sides of the same coin. It's unthinkable that we can sort of manage the orderly transition while at the same time this transition would create financial instabilities, poor risk management on the side of financial entities, lack of resilience, and what have you. So the main contribution that I think we can make is actually make sure that the financial sector is a source of stability. Is a source of stability that enables predictable transition plans. Now, the first thing we need to do is to develop better analytical tools, because the risk assessment here is still, I would say, in its embryonic phase. So, and in its embryonic phase, what do you need then is tools that help you in the process of price and risk discovery. So that's the items that already my colleagues talked about: disclosure and data gaps. So I fully underline everything that's been said on the importance of having a global baseline of mandatory disclosures. I think it's a huge step forward, and it is foundational in sort of getting this risk assessment to a higher level. Data gaps will need to be filled, and only that will then allow us as the global financial stability community to come to a much better sort of global and systemic vulnerability assessment. If you have the triangulation between the climate, the macroeconomy, and the financial sector, there are all kinds of interactions still that I think we need to better understand. But we can only better understand them if we sort of start making more progress in quantitative assessments, again, better data, better disclosures, and the like. And then finally, what we can do within the financial stability is also simply be a platform of exchanges of best practices, supervisory, regulatory practices. And in that sense, actually, we are coming full circle here, because that specific task will be taken on by Andrew within the FSB in his new role as chair of the Standing Committee on Supervisory and Regulatory Cooperation.
Great, thank you.
If I could add
Sarah.
just 3 quick things on the back of that. The first is we as regulators can look at firms' transition plans and understand, quality assure them, check they align with what they say on the tin. That's the first and most important thing we can do. Second thing we can usefully do, we can add them up at the level of the system and see what does that mean for the risks that are building. As Klaas said, our financial stability risks building here. And the third is exactly as Klaas said, to share best practice. This is a new and evolving field. None of us know how to do this well. And convening and sharing will be a really important thing.
Thank you. I think Eric wanted to come in with something else.
No, just basically underlining what has been said, but maybe coming back to the very fundamental point about disclosure. It's about getting the pricing mechanism work. So if we have the pricing mechanism work, then we will have a transition that is hopefully sound, right? So a lot of economists talk about the global carbon tax. That will probably not happen in the near future. But that says something of the idea that you could have behind disclosure, namely to have a pricing mechanism that actually price out things that are not sustainable and price in things that are sustainable. So disclosure is very much about that price signal where the financial sector could do what it's supposed to do, namely to channel savings to investments. Thanks.
Great. So I've got one more question, and then we'll see what time we've got left if there are any questions from the floor. So I think probably what we've seen is that there's been a shift to the imperative of building financial systems resilience to climate change at a national level. But I think what this discussion has really teed up is the issue of interoperability and harmonization. To what extent is that possible, and how is that possible? So I'd like to ask all the panelists really, in terms of your view on the importance of that coordination and alignment amongst regulators and policymakers in managing climate risks and achieving that. We've had a discussion about the role of scenarios, the power of transition, but we've also got to recognise that different countries are in a different place. So perhaps you could give your thoughts, each of you, about how we advance that interoperability and alignment to a goal that presumably we all share. And I'm very relaxed about which order you go in. Klaas, would you like to start? Do you look very eager to?
Yeah, because I really think that this is an area where we should not make the mistake to first create a lot of regulatory fragmentation and then have to work really, really hard to overcome that fragmentation and to come to global harmonization. I've been professionally involved for 20 years or so in harmonizing supervisory and regulatory standards. And in most of these areas, of course, there's been a long tradition, and countries within their own tradition have gone sometimes slightly different ways in which they manage and measure risk. And then it's quite difficult to sort of come to a global standard, because it essentially means that countries have to give up on some of their own traditions that serve them quite well. This is a new area. This is an emerging risk. We don't have the legacy at the national level, so let's not create the legacy, and let's make sure that the thought leadership on this issue also takes place within international groupings like the NGFS. That's the perfect laboratory, I would say, to study sort of the emerging risks that are related to climate. And I think it's absolutely vital that from day one we make this an international effort. I mean, the climate is global, right? It's a global public good. Financial stability is increasingly a global public good. I mean, for those who think that you can still manage financial stability at the national level and having an open financial system, well, I think the global financial crisis should have been a wake-up call already. But I think it's perfectly clear that in this area, the only way to go is global solutions and international from the start.
If I might build on that, reflecting very much on our experience in the NGFS, what I have found is that we start in the same place. So the scenarios are global, the supervisory practices are global, the data gaps are global, and then what can happen from there is you can take it down to the level that is relevant to your particular jurisdiction. It may be that physical risks are more important than transition risks in your jurisdiction. It may be that the climate data gaps are in a particular area. Climate policy may differ, and so the definition of what a net zero transition looks like differs. But if you start at the top in the same place and build from there, you can find a way of, exactly as you said, Minister, making things interoperable, ensuring that they can add up at the level of the globe. We've had good experience of that in the NGFS so far.
Okay, thank you. Andy, would you like to have some final comments?
Sure, thanks. Yeah, clearly international cooperation is essential in this area for the reasons that have been discussed. And it's important, I think, Klaus's point that this is a nascent area with a lot of scope to design things right across countries from the get-go. But it also being nascent means there's a lot of work to do in terms of data gaps, in terms of tools, in terms of metrics, in terms of then converting that into standards. And if we look at, say, the ISSB plan as an example, which aims to set up a baseline global standard, but I would emphasize the word baseline because different jurisdictions may want to do something slightly more. So as long as we have an agreed baseline, then other jurisdictions can kind of tailor it and do further steps if they so choose. But the baseline would then be harmonized, and of course, everybody should be engaged with each other so that we have interoperability and comparability no matter where you end up. So I guess maybe I'm not quite as strong as Klaus in terms of designing everything from the start together in one way, but allowing some differentiation as it's additive to the baseline, I think would be important.
Great. Eric, and then I'm going to ask Andrew and Nikhil to come in before I close.
No, but this is extremely important, and just to give you a little bit of the story how we worked with the global baseline together with the IFRS and how that started up. Of course, when we started to discuss this for 2 years ago, a lot of really senior global policymakers that I discussed with said, well, this will never happen. You can't do it in 2 years. I remember sitting in FSB meetings only a half year ago saying, are you crazy? You can't have a global baseline within a year. What happened, I think, here is that this is a clear and present danger. So it's not like should we have a little bit more capital requirement alignment. It's a clear and present danger, and everybody feels that from the general public, from the political system, domestically and internationally. So there is a kind of a strong pressure from the outside, and that has been important. Then every international body realized that, but to be honest, there are also some competition between international policy-setting bodies. That is not secret, I think. But what was extremely encouraging in this ISSB launch was that all of these bodies actually came together. So G7, G20, FSB, IOSCO, the Global Standards Set, the Basel Committee are all endorsing this, saying this is a good thing. Then there are flavors to it, as my US colleagues Andy expressed. Of course, some want to have more harmonization globally, somebody maybe a little bit less. But the overall kind of pathway, we all agree. And I think that's a little bit of a sunshine story, because doing that in 2 years, and I'm not praising myself now, I'm saying that, because this is IFRS, it's a lot of work, not least from the UK side, but I think it's extremely good example of how we could work when we really need to work.
I think it'd probably be great if we could hear from Andrew and Nikhil with any reflections on what you've heard this afternoon.
Well, thanks, John. I just wanted to actually add a thought on this global and international point, more from the point of economics, really. So, I think it's clear with climate change that the long-run benefits vastly outweigh the short-run costs, because the long-run benefits are about the future of this planet. But there are short-run costs. I mean, that's, I think, a point we just have to accept and realize and deal with. And having, as Klaus said, having a global approach to understanding, measuring, assessing those short-run costs is important. Andy's right, of course, you can go further. But I think having a baseline global approach towards those costs is essential. It's also, secondly, essential because, I'm going to use this term carefully given other debates, part of that, of course, is about valuing the externality of carbon. And again, what we don't want is that valuation process to become part of the bad side of trade policy, let's be honest. That would be a step backwards, and it would damage the global approach. So I do want to emphasize the point of view of sort of where we sit as a central bank with quite a strong emphasis on economics. I can't underestimate the importance of this global issue.
Thank you. I don't know if that's a message for us to wrap up, but yeah, I don't know if that's a message for us to wrap up. I was just going to add one point to this global harmonisation. I agree with what Andrew said. Global baseline. Some of us may want to go a bit further. Some of us may want to go a bit faster, but fundamentally going in the same direction. But this is one area where the public-private collaboration can really help us as regulators. And the Global Financial Alliance today is an example of how that could be effective, because actually global investors can apply a lot of pressure, particularly in our space, on disclosure, to bring global harmonisation and global coordination, particularly when it comes to corporate disclosures and private sector action. And so I think that partnership will be critical to driving this global approach and embedding it. Thanks.
Well, we have got a few minutes left, so I didn't anticipate doing this, but we could take a few short comments or questions. The two people over there and the lady over here. And here, perhaps you. Is that okay? The lady there first.
Hi, Sandy Look from the Marine Conservation Society. So thank you. It was so interesting listening to you today. And I just wanted to ask, we know that the nature crisis and emergency is intrinsically linked to the climate emergency crisis, and that includes the oceans. And I just wanted to ask, in the assessments you did and the scenarios, and also in the risk that you were looking at, how have you dealt with nature and ocean, both in terms of the damage being caused to it and the potential benefits of it?
Great. If there are short comments or questions from over there, could you possibly? Yeah, thanks. Thanks, Stephanie.
Hi, Chris Hon, Children's Investment Foundation. The UK signed the Paris Agreement, which requires by 2030, halving emissions. So why do we need to do sensitivity analysis when we know the goals are basically to achieve that, to reduce emissions by 7% a year? And if banks aren't doing that through decarbonizing their loan book, why aren't they being forced by regulators and the Bank of England to do so? It seems, and related to that, well, a separate point is, why isn't the Bank of England making it mandatory that all banks collect the emissions data from all their borrowers? Otherwise, this whole process doesn't work.
And I have one more.
Thank you, Jacob Tomei, 2 Degrees Investing Initiative. Basel III has carve-outs for export finance to support financing low-income countries, explicitly with a policy objective. So I'm wondering why there is a sense that we need to have risk-based justifications for capital adjustments in the climate area when those risk-based justifications are not necessary in other Basel III policy carve-outs.
Right, we've got 2 minutes, so please, please pick your question and succinct.
I don't know that I'm going to be able to do justice to all of those 3 in 2 minutes. Nature and the oceans is the next frontier. We are early in our understanding of that, and there is a lot more to do. On capital and the role of that, what's really important is that central banks stick to their mandates. That's dealing with the consequences of climate change, not dealing with its causes. In respect of that, we absolutely will look at, through our stress testing and our scenario analysis, what firms are doing, and we will ensure that they are collecting the data they need. That was the pivot in supervision, the shifting gears that Andrew mentioned earlier.
Thank you. Any of the panelists got any other final comments? You don't have to have any. Go for
then
it.
I will simply underline what Sarah said. I think she said it very eloquently.
Okay, well, I'd just like to thank everyone for coming this afternoon. I thank our 2 excellent speakers and the panelists. Obviously, this is an incredibly complex area. that we have still got a lot more work to do to get to that harmonised set of outcomes that we need. But I'm never complacent in this area, and I recognise the frustration of some about the rapidity of the journey. But we live in a complex world, and we will continue to strive to make more progress. So thank you very much for everyone for attending this afternoon. I hope you found that a productive conversation.